We have been seeing this heating up in the oil market in just the last week or two, and yet, the situation doesn't seem to have changed all that much. We knew about OPEC plus cuts, and we knew that the geopolitical situation was a bit volatile. So what is different?
Good morning, Vonnie. So I think the risk premium in crude has gone up, particularly since Ukraine began its spate of drone attacks against Russian refineries. And you'll recall that happened pretty much through March. And of late, we've seen, it's a two-pronged risk premium in crude. So we've also seen the Middle East tensions bubble up again. More recently, of course, this week, the tensions between Iran and Israel came to the fore with the missile attack on the Iranian embassy in Syria. So it's, I would say, about $12 to $15 per barrel of risk premium, of essentially stemming from fear more than an actual reduction in supply, fear of supply disruptions from the Middle East.
Exactly. So in that context, is $100 a barrel, that forecast that JP Morgan is putting forward, just a little bit too optimistic?
I would say let's be a little beware of a confirmation bias. When prices start going up, it's quite typical that when they approach 90, people start talking of $100 a barrel. It's not my base case, Vonnie. As I mentioned, there is a $12 to $15 risk fear premium, essentially, let's call it that. If we do see some of that fear recede and supplies not actually get affected to the extent perhaps that the market is fearing they might, I think some of this froth should settle, in which case we should see Brent probably climb back below $80 a barrel. So could they remain around current levels? Yes, because again, I don't see anything in the near future that would ease these concerns. But at the same time, I really don't see $100 a barrel anytime soon.
If prices stay where they are, I mean, that's going to please OPEC Plus members, right? But is there any chance that they might put some supply back on the table after the June cuts run out?
So indeed, prices are in the sweet spot right now for OPEC Plus. But again, if they are also looking at what I am looking at, which is essentially quite a bit of this current strength in crude is as a result of a geopolitical risk premium, which could ease if conditions were to abate a little bit, let's say in Gaza, and especially if Ukraine were to ease again on the drone strikes in Russia. And we know for a fact that the U.S. has been asking Ukraine to step back from that. So should the conditions ease and prices settle back below $80 a barrel, then I don't think OPEC Plus would feel comfortable in bringing supplies back, because if you're below 80 for Brent and OPEC Plus starts putting more oil back into the market, they are creating conditions for Brent to go back towards $70 a barrel even, which I think is their sort of threshold. So my base case is other things being equal, unless we see some major upheavals in the market on the supply or demand front, my base case would be that they would probably need to extend these cuts further into Q3. I do think they'll continue going quarter by quarter because of the huge uncertainty on both the supply and demand front this year.
Vandana, I have to ask you about natural gas. It's obviously a hugely different market in Europe than in the United States, than in other parts of the world. But we saw a huge volatility, particularly in European prices, and then an extreme drop in US prices over the last several months to a year. Does that continue? What's the catalyst that changes the dynamic in the natural gas markets?
Yeah, attention has shifted away from the markets for good reasons. They've been pretty calm, as you mentioned. I think the Northern Hemisphere has really benefited, especially definitely advantageous for Europe, in having a second back-to-back warmer winter than usual. So we see gas inventories, gas in storage has been plentiful. Europe, in fact, has the highest levels of gas in storage for this time of the year. So by all accounts, it looks like summer and the restocking of gas through summer for Europe is also going to be quite comfortable. We see benchmark prices in Europe have calmed down. LNG spot market prices have also calmed down. So generally, things have settled. I would say, though, that we have to keep two issues in mind. First of all, season are unpredictable. We don't know what the 24-25 winter is going to bring. Another harsh winter could create more problems for Europe on the gas front. The other factor to keep in mind is that the rewiring of Europe's gas supplies away from Russia is not complete. Europe is still getting about 15% of its total gas imports from Russia, some by pipeline, some by LNG. A pipeline that comes via Ukraine, that contract is going to end at the end of this year, not going to be renewed. So I think it will take the next few years for all of this to settle down completely. So definitely a market to continue watching. But for now, it's a sigh of relief for the next few months.